Hi, good morning, everybody. Thank you so much for joining SCB10X REDeFiNE Tomorrow. This is our third year of doing this DeFi and Web3 virtual summit. I'm Thai Panish, CIO of SCB10X. And with me again, for the third time, I have Robert Leshner, founder and CEO of Compound, which is the most well-known interest rate market DeFi protocol. There is so much to talk about, Robert, this year. We are in crypto winter and there are just so many things happening. But before we start, can you please introduce yourself to the audience and talk about Compound, why you started it and your vision and goal?
Sure. So I'm Robert Leshner. I'm the founder of Compound. It's one of the first DeFi applications. And the purpose of it is to create an interest rate marketplace where users around the world can borrow using crypto as collateral. And the advantage of Compound as a protocol is that the entire thing is running on a blockchain transparently and autonomously 24/7. And it's been able to operate for years without fault, without ever, having any issues where users have ever, lost funds or have had to deal with uncertainty at a scale that, is meaningful. So over the last couple of years, Compound has been managing tens of billions of dollars entirely transparently using computer programs.
Yeah, so Robert, right now we are in deleveraging crisis. Basically, I think in the last 2 years, there were some players, CeFi players that use a lot of leverage, and nobody actually really realized how much leverage they have been using. And also there's not much transparency what's going on, and the counterparties that they have been doing business with and things like that. And so that's why we are in this crisis right now. Maybe could you please give your point of view on what's going on, why we have this deleveraging crisis, and is there any challenges and opportunities that impact Compound right now from this?
Well, this is not the first crisis that's come about in terms of lenders operating by taking on too much risk. I started my career on Wall Street in the US in 2007 when the US was about to experience a major liquidity crisis, which was the result of lenders taking on risks that were opaque and not known to anybody else. And so the amount of leverage was increasing out, this system as a whole realizing that the risk was increasing. And it ended, with a lot of losses that occurred very quickly. And what we're seeing in crypto right now is the exact same pattern repeating itself, where a number of centralized businesses that knew their own books, but nobody else knew their books, were increasing the amount of risk that they were taking until suddenly there was a lot of losses realized very rapidly. And the reason why this occurred, both in 2007 and in 2022, is because none of these businesses that were taking on increasing amounts of risk and increasing amounts of leverage were transparent with the public, with users at large, about their balance sheets, about their businesses, and about their policies. And one of the greatest promises of DeFi and crypto is that when everything operates on a shared public ledger, everybody has the same amount of information at all times. And it can prevent this exact situation from occurring again, which is everyone knows what they hold, but no one else does. And so what we're seeing right now, I think, is the greatest opportunity for DeFi and the greatest opportunity for the Compound protocol and the greatest opportunity for people that are observing DeFi and learning from it for the first time, because they can start to see that it operates differently. Instead of operating on spreadsheets that are not visible to anybody externally, DeFi operates on shared public ledgers. And the health of the system is auditable by anybody in real time, by all of the users, by all of the market participants, and by any external observer. And I think what it's doing is creating a sense of understanding about why DeFi is different and how it's a different form of undertaking business. And long term, I actually think that this, what appears to be a crisis is going to be an incredible learning opportunity for the entire industry to, building businesses with open source computer programs instead of spreadsheets that are only visible to the owners.
Yeah. So Robert, with what's going on with the Cefi players, basically like some of the Cefi players, they gave this credit worthiness to some of the bad players that probably have like this very high prestige image, that they have a very strong business and trading very well and have very good like credit worthiness, but they are not. And basically like these lenders didn't ask for collateral, but for DeFi, you guys always ask for over collateral, and a lot of people complain that this is capital inefficiency, and then there's a drive toward under collateral and no collateral at all in DeFi. Will we still see that situation going forward? Because now it seems to us that having collateral is actually like the best thing.
Yeah. So I think what's going to happen is people are going to see the advantages of over-collateralization. The advantage of over-collateralization is that you can make a credit decision instantly. It doesn't have to be based on the character or your judgment of the counterparty. It doesn't have to be based on their reputation at all. Over-collateralization is really easy. It's extremely simple for a computer program running on a blockchain to extend money to someone on an over-collateralized basis. It requires way more judgment when it's based on the credit worthiness of, on the assumption of their business model instead of collateral that they hold. And I don't actually think that DeFi is necessarily good at making those decisions. I think those decisions are best when you have a lot of humans with a lot of judgment and a lot of experience, really getting to know borrowers who don't want to use collateral extremely closely, having a lot of truth about what their business is. I don't want to point fingers, but a lot of the borrowers, and that created this issue in crypto today weren't being fully truthful about the state of their business. But I think that like uncollateralized or under collateralized, decision making is best done off chain. Whereas I think DeFi is actually exceptional when a computer program can make all of the decisions. And, that's simplest when something is fully collateralized.
Got it. So in your opinion, you think that DeFi will continue to be over collateral and best be that way, yeah?
For now. And there's obviously like many hybrid approaches where people are using DeFi to connect capital. And it's not about making the credit decisions, but it's about connecting those with an excess of capital with those who need the capital, and someone else's computer program. But I think for the most part, what DeFi lends itself well to is things that computer programs can execute.
Got it. And Robert, let's say if someone want to task you to come and fix the problem that the Cefi players have right now, what will you recommend? Will it be more like having a lot of regulation? So, they have to do a lot of risk management. They have to follow all these parameters that normally banks have to follow, and they cannot, say that they do one thing and then they do the others.
Well, I see really two opportunities to fix. So the first way to fix a lot of the problems is for the businesses and the entities in the space to learn from DeFi, to be more transparent about their own businesses. So a great example of this is, a DeFi protocol like Compound is radically transparent. You can inspect the health of the protocol. You can see all of the assets, where they are, how it's operating 24/7. But a centralized business that's borrowing money and making loans, you have no visibility into. So I think the first way that Cefi can fix itself is to learn from DeFi and just be more transparent. Publish their financials. Publish in an anonymized fashion, what their loan book looks like, what their balance sheet looks like, so that their counterparties can just understand, is it, 90% of their book is being lent to one counterparty, in the example of someone like a Voyager, or, is it, a well-distributed balance sheet? They can just take some of the principles from DeFi when it comes to transparency and learn from them. The second way that Cefi can fix itself is by welcoming in third parties. And, I don't know, independent risk measuring entities like credit bureaus and rating agencies. So a great example of this is, traditionally, a lot of, financial instruments are rated in one way or another, where you have a third party coming in and assessing a business relative to its peers. They don't have to publish all of the financials of the business, but they can say, hey, we've looked at the business and based on what we understand, it's this risky, or it's less risky, or it's even less risky. And that way, everyone externally can get comfortable with it, even if they don't have the same level of transparency from something like DeFi. And I think that's an intermediate step, is having third parties come in and at least in some sense certify the risk of these businesses if they're not willing to be radically transparent. And I think all of these are steps towards, better business. And I just think that we're in a very early stage of the market for crypto centralized entities that were behaving badly, took a lot of losses as a result, and are going to have to change their business practices.
Got it. Yeah, let's talk about risk management in Compound. So Gauntlet actually has the risk dashboard, that they created for Compound, and then they also regularly do the risk recommendation. Yeah, so how effective is that? And maybe could you please talk more about this?
Yeah, that's a great question. So Compound at the end of the day is a risk management protocol where the parameters of the protocol dictate how much you can borrow using crypto as collateral, and what interest rate you have to pay to borrow those assets. And this requires a level that many people don't day-to-day. It's a protocol that anybody can change to through the community governance process, but these parameters have a lot of impact and influence on the risk of the protocol. And so a third party, which is called gone through the Compound protocol. It's a team of quantitative analysts and researchers and modelers who are running a lot of simulations with the risk parameters of the protocol. They basically are, running these big computer simulations that say, if we change this parameter, how much does it increase the risk to users? Is that except instances of a company that is in the business of servicing a protocol and a DAO directly? And so, the decision making around risk is not being handled by the original developers of the protocol, which is Compound Labs. It's not being handled by a broad community of users. It's being handled by a specialist that all they're doing is focusing just on the risk parameters of this protocol. And in some sense, this is an experiment, but I think it's indicative of where protocols are headed and what professional service firms that service protocols are going to look like. And they're providing an exceptional service. They've been managing the risk of the protocol spectacularly. To this day, there have been zero losses to the users supplying funds to the protocol. And you have a professional firm modeling risk and recommending changes to the risk parameters. When they recommend changes, users can approve or deny their recommendations. But in a lot of ways, this is starting to look like what a DAO is going to be at scale, which is, different individual firms providing inputs to a really large system, and together it operates in a way that's super effective. So I'm really excited to aspects of running a multi-billion-dollar protocol like Compound. And I think this is a way that, you're going to see a lot more protocols move towards over the next couple of years.
All right, that sounds great. Yeah, and tomorrow, Tarun, the founder of Gauntlet, will be here as well at the conference. So tune in. Maybe shift gear a little bit and let's talk about regulation. Yeah, what is your view, Robert? That how are we going to see the regulator responding to the crisis that we are in right now?
Yeah, that's also a great question. So, the first thing to understand is that regulation is NASH's its own regulators. Second, I think what we're starting, to expect is that regulators turn their attention to solving the problems where, broad consumers are losing money. And today, the place that a lot of consumers are losing money or losing access to their money are halting withdrawals, that are going bankrupt, and that are changing the way that they operate without any warning. And we've seen a number of major, freezes and bankruptcies just over the last couple of weeks. And I think what the natural question to ask is, how would regulators solve this in the future? How would they prevent the next Celsius or the next Voyager freezes user withdrawals until they can go through a bank and restructure? Because a lot of these users didn't think that they were taking on risk. They didn't expect they would take losses if the entity failed, and they didn't understand what was occurring under the hood. And I don't think regulators understood what was occurring under the hood, and I don't think the users did either. So I think the most important area that I think regulators are going to turn their attention to are the businesses that are failing and trying to prevent that failure from happening again. And so, I personally expect there's going to be more regulation around the transparency that, whether that's around what happens to assets in a bankruptcy or their current business models, because there's also just a lot of uncertainty about what they were even doing, with people behaving differently and doing something else entirely. So I think, the biggest opportunity for regulators is to just increase the amount of transparency around these businesses, make them, communicate better with their users, improve their disclosures, create standards by which, they talk about their businesses so that their customers can be well informed and not feel like they're being left in the dark. So I think there's a lot of opportunities for regulators. I think it's going to come from increasing transparency and getting the operators and, the markets to the standards that are seen with other types of financial platforms.
Yeah. So DeFi really proved that it's worked well even during the crisis. But do you think that there might be some regulations coming into DeFi as well?
DeFi is, a lot of the virtues that regulators will want to demand from centralized platforms. DeFi platforms are already radically transparent. They're already providing extreme visibility into how they operate, extreme visibility into the state of the business, and they can't change the way they operate. With these DeFi platforms are already the end state of what regulators are going to want and demand from centralized platforms. The perfect entity to a regulator is one that does what it says it's going to do always, that's completely transparent, and can't be a platform that users, are, being deceived on. And so I think what's going to happen over time is that CeFi platforms are going to become more like DeFi platforms, and that, regulators are going to demand that, CeFi learns from DeFi.
Let's talk about compound treasury, which is institutional DeFi. That is basically the platform that let institutionals be able to earn yield from DeFi, 4% fixed yield, and don't have to be worried about complexity of crypto. Yeah, so far, how is the traction there? And, with the crypto winter that we are in right now, is there any change in terms of the institution interest into compound treasury?
So there's a lot of interest in compound treasury. And you said it best. What compound treasury is doing is abstracting away a lot of the complexities of interacting with the DeFi protocol. Doesn't have to manage private keys. They don't have to interact with smart contracts. They can to interact with DeFi on their behalf. And we're seeing two things. One is that, institutions are extremely excited about this market, but they're also nervous because they're seeing a lot of CeFi failures all around them. And at this moment, it's hard for a new market participant to differentiate CeFi and DeFi. They see a platform like Celsius or Voyager or 3 Arrows Capital imploding, and all they see is, hey, this is crypto. Yet, fully educated on what the difference between how those businesses operate and how a smart contract-based, open source, autonomous protocol operates. And so I think what we're seeing is, a lot of enthusiasm for the virtues that DeFi represents. We're seeing institutions becoming this, but I think they're also skeptical of the on and off ramps to DeFi, and Compound Treasury is an on and off ramp to DeFi. So we're seeing both lots of new customers, but also a lot of institutions saying like, whoa, there's a lot of bad things happening in crypto. I'm going to slow down my analysis of the market and not rush for all of these centralized businesses blew up.
Okay. And so right now the interest rate that in compound interest rate market for USDC is yielding less than 4% interest. And so compound treasury has to subsidize the interest to the depositor. Yeah, so how will that work out? And also, is there a way to make it more transparent for the institution to see that what's going on, how are you subsidizing and things like that?
Yeah, that's a great question. So it changes every single day. And Compound Treasury, what it offers is a fixed interest rate, and the business earns whatever the Compound protocol yields. And it makes up the difference in its own capital. If there's a lower interest rate in the Compound protocol, and if interest rates are higher in the Compound protocol, the business turns a profit. And over the last 2 years, the interest rates in the Compound protocol have been extremely volatile. In general, they've averaged about 5%. But on any given day or any given month, they can be substantially lower or substantially higher. So today, the Compound protocol yields less than 4%. And, the Compound Treasury business is providing its own capital in order to pay its customers a fixed. This is, a loss leader to integrate Compound Treasury into the broader financial ecosystem. But, as interest rates in crypto go up, it's also a profit generating entity. And so, one of the nice things about a business like Compound Treasury is that it is rated by S&P Global, which is a rating agency that analyzes the capital of the business and ensures that it's sustainable and is able to provide commentary and ongoing surveillance of the business to determine whether or not, its subsidization of an interest rate when it's lower than 4% is sustainable, and whether it's, profitable when it's over 4%. And so, a lot of CeFi products are going to, I think, inherit the rating agency process. And I think we're going to see more and more external ratings enter CeFi and DeFi applications. But product monitor the capital of the business and the economics of it.
Okay, so let's talk about what can be the next driver for the bull market. In the past bull market, back in 2020, compound pretty much the main reason why we had the bull run, the DeFi summer. What do you think can be the next catalyst for, for us to get out of this crypto winter and have the next bull run?
Well, I think there's really two catalysts for the next bull market. The first one, I think, is going to be improvements in the technology around DeFi. I think a big opportunity are zero knowledge based DeFi applications and systems. This is, a very early stage of industry research, but one of the biggest objections that financial market participants have about using DeFi is that all of their transactions are public. And zero knowledge proofs and zero knowledge computation offers the opportunity for DeFi not to be overly transparent on an individual basis, but allow market participants to understand the health of the underlying protocol and system. So, driver of DeFi, and I think as they start to reach production, are going to be driving a lot of usage into the ecosystem. So I'm really excited about zero knowledge proofs and the opportunities there.
Got it.
The second thing that I think is going to be a major catalyst for the continued and renewed growth of crypto in general is actually more global in nature, and it really just comes down to global macroeconomic conditions. And I think the next major driver is going to be one when there's more global peace and prosperity, and when inflation starts to come down in major developed economies like the US, but also major economies abroad, and interest rates both in the US and abroad begin to come down a little bit, because that's for in a lot of ways what someone calls a long duration asset like crypto, where it highly susceptible cash flows typically. I think that'll be a major driver. So I think in the next 18 to 24 months, we'll start to see the macroeconomic conditions become a major tailwind for crypto instead of being a headwind.
How about any area of Web3 you are excited about? Is there any in Web3?
I'm really excited about the social aspects of Web3 more than anything else. So historically, Web3 has been relatively small as a market, and really for early adopters. But I don't think a market that has 1 million participants is best when there's 100 million participants who are excited about it. And in order to go from 1 million participants to 100 million participants, you really need to engage a lot of people in a way that's entertaining and communal. And so I think the projects and the teams that are exploring the social elements of Web3 are the ones that are going to help catapult the market forward, because they're going to take Web3 from a very small and focused market of early adopters to one in which it's a much larger majority of users that can go from 1 million users to 100 million users. And so the areas that I'm most excited about are social, iterative, and increase the bonds between people globally.
Got it. And Robert, curious, because you are prolific investor, angel investor through Robot Ventures, and you are also, of course, the founder and CEO of Compound. How do you split the time?
I'm mostly focused on Compound, but on nights and weekends, I run a venture fund called Robot Ventures.
Got it. Okay. Well, we have only 2 minutes left, but any thought about Compound going cross-chain, going multi-chain? Are we going to see Compound in other chain very soon?
Yeah, so Compound is one of the oldest protocols, and it's always been exclusively focused on the Ethereum mainnet. One of the things that's happening right now is that Compound Labs, which originally built the Compound protocol, is releasing a version of Compound that's designed for the community to release it on many different blockchains. And so, I'm a big believer that there's not going to be one blockchain that succeeds. There's going to be many blockchains that are successful. And where assets live and where DeFi lives and where users live, it's not just going to be on Ethereum mainnet. It's going to be on probably 10 different major blockchains that all share usage and adoption. And so we're really spending a lot of time trying to revamp Compound so that it can live on 10 different blockchains. It can be governed by one community of token holders successfully across 10 different blockchains. And it can work with the different communities wherever they exist.
Okay, all right. Yeah, I think our time is up. Thank you so much again, Robert, for joining us. Hope to see you again next year at our 4th REDeFiNE Tomorrow. But I also would love to see you, somewhere in Singapore or Thailand, this side of the continent. I have seen you in New York back in May, but yeah, would love to see you here.
All right, sometime soon. Thank you, Kai, and thank you, everybody.
Bye. Thanks, Robert.